Hey everyone, welcome to the Weekend Charts, where I run through the most important charts and themes in markets and investing. Another big show for you this week, a lot to discuss. Today's show is brought to you by my friends at Y Charts. Y Charts aims to help you achieve all of your investing goals packed into one simple solution. With Y Charts, you can turn your investing questions into actionable insights. So take a look at the show notes for a link to a free trial to Y Charts and tell them I sent you to get 20% off when you first sign up for the service. So let's start out by talking about the housing market. And this has been a big focus for us in recent months because the downturn in the housing market really continues. And this first chart here illustrates an important factor, rising supply of new homes. And we haven't seen the supply of new homes this high in quite some time. And importantly, the last four times we saw the supply of new homes this high, over 10 months, the US economy was in a recession. So clearly something is changing here. As we've talked about, affordability is the big factor. Fewer people can afford the average home. That's led to a decline in demand. Home builders have talked about having to cut their prices to incentivize people to buy. And so this type of situation will likely lead to lower prices of new homes to come. If we look at the homes that are selling, interesting thing that just happened recently is the average price of a home sold is now below the listing price. And so for a long time in 2021 and even earlier this year, homes were selling above the listing price as there were bidding wars, so multiple people bidding on a single home. Now we're starting to see the opposite situation where fewer people are bidding. And the result of that is now, as we said, the average price of a home sold is below the list price. The last time we saw that was in early 2021. Another interesting thing to see here is the decline in home prices from the peak in June. And it's really starting to pick up a little bit. Still not a huge decline, but now it's up to 6%. So home prices peaked here in mid June. And they're down around 6% since then on average. So we'll watch this closely. Again, affordability, the big factor leading to a decline in demand. And we have that supply equation, which is starting to move higher as well. So both of those factors driving home prices lower over the past few months. So what does a home buyer think about when they're thinking about purchasing a home? Well, they usually do some type of calculation comparing the cost of renting a similar place versus the cost of owning, which the big cost of owning, of course, is going to be that monthly mortgage payment. And so let's take a look at some of the trends in both of these areas. First, we have rents, and we've talked about this every month, and the trend continues in terms of rents hitting a new all-time high again in August, up 10% year over year. But the difference is now this rate of change is starting to slow pretty dramatically. So 10% still above the rate of inflation, but much lower than we were where we were at the start of the year. So we're starting to see the rate of change slow. That's good news for renters. That's going to be good news for the overall inflation picture when it continues. I think it will, as the months continue here. But the fact is, rents are still hitting new highs. So we want to see this slow down to help the overall inflation picture. But if we look at the mortgage calculation, it's an interesting thing here. We're seeing mortgages rise much faster than the rise in rents. And what that's leading to is this ratio of mortgage payments to rents being at its highest level, almost 1.5 times. If we look at a ratio of the two, that's the highest we've seen with data going back to 2009. So, as much as rents have gone up over the past 2 years, the mortgage payments have gone up more. And why is that the case? Two really factors driving that. Number one would be home prices and how much they've gone up over the last 2 years. So we've seen a 40% increase in home prices over the last 2 years alone. So that's higher than the increase in rents. And that's, of course, much higher than the increase in people's incomes or wages. So that's leading to a lower affordability. And this is a chart here showing you the Case-Shiller National Home Price Index as of June. So we saw the Redfin data showing prices have declined since their peak in June. But here, if we look as of June, the housing market in the US had hit an all time high for the 68th month in a row. So, again, a huge advance over the last 2 years, 40% increase. And that's driving higher mortgage payments. And the other side of it is the mortgage rates themselves. And so this is a chart. We usually look at the 30-year, but this time I wanted to look at the 15-year mortgage rate. That's up to almost 5%. It hit an all-time low last year at 2.1%. So substantial increase in the mortgage rate over just a very short period of time. We haven't seen this in a long time. So both of these factors, you have rising home prices, rising mortgage rates, leading to higher mortgage payments. And if we compare that to rents, it's the highest ratio we've seen in quite some time. So let's shift gears, talk about the Fed. Fed had a big meeting at Jackson Hole that they have every year. And some of the comments I think were received by the market to be more hawkish than they thought. I'm not sure why that was the case because I didn't really see much in the language that was different. The Fed is still planning on hiking rates. That was really no change. They're still planning on shrinking their balance sheet. That was really no change. But I think it was just the tone of the rhetoric that kind of spooked markets to say that the Fed really is intent on bringing that rate of inflation down. And I think Chair Powell used language to make that clear. I think it was a good thing that he said it. He's saying they're going to keep at it until the job is done. And so this idea that just because the inflation rate came down to 8.5%, and it's likely to continue move lower in August as well, that the Fed is going to stop normalizing interest rates. I think you could throw that out for the time being. 8.5% is still, of course, very high, and the Fed not only wants to bring the rate down, but they want to make sure it stays down, and they really want inflation expectations to come down and stay down as well. So, a big driver of inflation, of course, is that expectations component. And looking into the future, if you want to keep it down, you're going to have to get people to think differently about inflation. And so, as we've talked about, people have become less sensitive to the idea that prices are going up, and that's an additional factor driving prices higher. So, Fed is going to continue to hike rates. They're going to continue to shrink their balance sheet. And if we put it in perspective here, the decline in the balance sheet so far has been pretty minimal. If we look at from its peak in April, it's down only 135 billion, and so that's still higher. I think it would be surprising to know that that's still higher than where we started the year. So in a year in which inflation hit a 40-year high, we still have a higher balance sheet than where we started the year. So this is expected to change. This is expected to accelerate starting here in September at a rate of around 95 billion per month. So if that is indeed what happens, what we're going to see is the first decline on a calendar year basis for the Fed's balance sheet since 2018. And I think it would be the largest percentage decline since then as well. And so perhaps not coincidentally, that was the last year of 2018 that the stock market declined. And of course, we're seeing a big decline this year as well, as we'll talk about in a bit. So the market clearly doesn't like that shift from expanding the balance sheet to shrinking it. And for now, people are just going to have to accept that the Fed is going to continue to move in that direction. And so if we look at the interest rate picture, this is, of course, a bigger factor in my view than the balance sheet. We have continued hikes to come here. This is a chart showing you the projected path of the Fed funds rate based on Fed funds futures. So this is market-based expectations. What is the market expecting? They're expecting hikes to around 4% by early next year. They're expecting the hikes to be front loaded. So they're expecting the bigger hikes to come in this month, September, maybe even November, and then significant slowdown and really the Fed stopping at some point in early 2023, maybe even at the end of this year. The Fed is likely to move 50 or 75 basis points when they meet in September. So we're getting close to that 3% level that we haven't seen in a long time. And interestingly, though, if you look at this chart, you'll notice that it starts moving in the other direction in the back half of 2023. So markets actually expecting the Fed to reverse course, start cutting interest rates, and easing monetary policy starting in the back half of 2023. And you might be wondering, well, why would the Fed do such a thing given the threats of inflation today? Uh, and I think there's a few reasons, but the primary one would be the expectation that the economy is really slowing, and that the expectation that inflation rate's going to come down, so that the Fed will be in a position at that point to start cutting interest rates. And so, in terms of the economy, well, the Fed hasn't acknowledged the recession or the risk of recession. What we're seeing here is that people are feeling it more and more. So I've done this poll every month or two, and this is the highest percentage of people saying that the U.S. economy is in a recession. So if we look at that Fed funds futures curve, people are expecting, I think, that the Fed will be acknowledging that economic weakness more next year. That, coupled with the lower inflation rate, will give them room to say, we can either stop hiking interest rates or start cutting, moving in the other direction. And last point on the Jackson Hole, thought this was an important one that the Fed really hasn't fully acknowledged, but it's something that we've talked about a lot. I think this was a great statement from the Fed chair in terms of he's saying that there's a trade off here, that we have to take some short term pain to avoid that really high rates of inflation continuing in the future, which would be a much worse scenario. So he's acknowledging that those continued rate hikes here are going to bring some pain to households and businesses. But this is the cost of reducing inflation, and failure to do that is going to mean greater pain. And so I think I think that's spot on. That we have to accept some pain for that long term gain. And so we did the same thing in the early 1980s. Of course, we hiked interest rates much higher than today. It did cause two recessions in the early 1980s, but we came out of that much stronger, and inflation really wasn't an issue again until just recently. So hopefully we follow that similar path. We take some short-term pain, and then we try to move on and have better economic growth, more stable and sound monetary policy, and people can be confident that their wages won't be outpaced by inflation. And that's really the big factor. You can't have this. You can't have long-term prosperity with inflation being higher than people's incomes, because it just leads to a continual decline in purchasing power. And so that is a much greater risk than short-term economic weakness. So let's talk about that, the risk of that weakness. And what was noticeably absent, I think, from the Jackson Hole speech was this concept of a soft landing. And so Powell had talked about in recent meetings what they hope to achieve, which is known as a soft landing. And that's basically just that the economy doesn't go into an outright recession. It's just slower growth rates. And I think we would all hope that would be the outcome instead of a recession. But realistically, what are the odds of us achieving that if the Fed is going to continue to tighten policy and curb demand? Is that likely to lead to a soft landing instead of a recession? So I went back in history here, looked the last 5 times the Fed was hiking rates and that inflation had peaked above 5%. What happened in the US economy? And what we can see here is in 1970, 73, 75, early 1980s, early 1990s, and 2008. Each time that inflation went above 5%, hit a peak, and came back down, it was really a recession that was part of bringing it back down. So that recession, in part, coupled with tighter monetary policy, really was the catalyst to bring down the rate of inflation. So could this time be different? Anything's possible in markets, but it seems the odds of that happening are not likely. We're more likely to experience a downturn in the economy. And in fact, as we talked about, we've already had 2 consecutive quarters here of negative GDP growth. So I think the thing that stands out, if we're looking at this relationship between the inflation rate and the Fed funds rate, is still the wide gap between the two. So we still have an over 6% gap, with inflation being 6% higher than the Fed funds rate. So some might consider this to be still very easy monetary policy given where the inflation rate is. And so you might be thinking that the dollar, given that, would be going down in value. But if we take a look at the dollar, we're seeing the exact opposite. We're seeing the US dollar index actually hit its highest levels since 2002. And so, what's going on here? Why is the dollar so strong, even though the Fed is still far behind the inflation curve? Well, as we've talked about with currencies, it's all relative. And if we look at the components of that dollar index, it's the euro that's by far the largest percentage. So the dollar or any currency can't be viewed on its own. It's always relative to something else, so some other currency. And in this case, as much as the Fed has been behind the curve in terms of inflation, the ECB, the European Central Bank, has been even further behind the curve. So I think this chart really illustrates that. We had inflation in the Eurozone rising above 9%, highest level ever for that area. And we had the ECB only recently moving out of that negative interest rate territory, and they just moved rates back to zero. So over a 9% gap between their central bank rate and inflation, higher than the gap in the US. And so we have this situation where the euro is really going down in value significantly, and that's leading the dollar to go up in terms of its strength. So, will this continue? Well, that's going to be dependent on whether the Fed is more aggressive than ECB in years to come, in part. And so the expectation right now is still that the Fed is going to be more aggressive in the next few months than the ECB in hiking rates. But that could change, of course, at any point. The ECB might have a change of heart and quickly raise rates to 1 to 3%. And if that were to happen, I think you're going to have a change in the dynamics of the currency market. So it's very difficult to predict currencies over any period of time. But here we have a clear reason why the US dollar is strong. It's not because the Fed is monetary policy should be viewed as tight at this point. It's because other monetary policies are still so easy. So you have the ECB and the Bank of Japan still in very much easy mode relative to the Fed. So let's talk about the stock market. It's been quite a volatile year this year. There's many different ways to measure that, but I put together this table looking at annualized volatility, so just standard deviation of the markets. And if you've been watching the markets, the swings have been pretty big back and forth. It's not just your imagination. The annualized volatility for the S&P much higher than its historical average, 23.7%. If we look at the years where volatility has been higher than this year, it's not really good company. You have the 1930s, where you had the Great Depression and World War II. You have 2020 pandemic crash. You have the 2009, the end of the financial crisis and that deep recession. And you have 2002, which was the end of the dot-com bubble bursting. So all of these years, difficult times for markets, big swings back and forth. What's interesting about this year is that we've already seen 7 declines in the market of greater than 3%. These are so individual trading days down 3% or more. And if we look back in the past 70 years, there's only been 3 years where we've seen more on a full calendar year basis. And those 3 years are just 2020 here, 2009, and 2008. So rare company in terms of swings in the market. High volatility, of course, tends to be a sign of economic uncertainty. So when people are uncertain about how the economy is going to be doing or earnings are going to be doing, they're more likely to trade and reactive on that news, and the swings are likely to be bigger. So that's exactly what we're seeing this year. And so we'll see if that volatility continues. But already at this point, it's been one of the most volatile years that we've seen. And certainly we'd like to see volatility come down. But this is a feature of markets, not a bug. Over the long run, why one of the big reasons why you're paid for investing in equities is because you're bearing this risk of higher volatility. So you really can't have one without the other. It's just hard to stomach when you're living in it. So Volatility is certainly on the minds of investors. I think that's leading to fears that the worst may not be over. But I think if we look at the markets, there are a number of factors really causing people to believe that the bear market still has more to go. First, let's look at where we are today in terms of the S&P 500. Still one of the worst starts in history, fourth worst through 169 trading days, down 17.7%. Only a few years in history have had a worse start at this point than 2022. And if we look at a 60-40 portfolio, what we're seeing there is actually the worst that we've ever seen. So stocks and bonds are both down over 10% this year. That's something we've never seen going back to 1976. And it's really been a function that higher interest rates are one of the proximate causes for the market coming down. So higher inflation rates tend to lead to higher interest rates, and that's leading to concerns about the impact on the economy, as we've seen. Unlike many years past in history, when the stock market had big declines, typically you see bonds go up because interest rates fall, and we're seeing the opposite this year. So, pretty difficult year for investors. So, you might assume that they'd be thinking the worst is over, but I think there's three reasons that people are pointing to say that perhaps there's still, unfortunately, more to come. I think the number one reason people are pointed to is earnings. So people think about earnings driving stock prices, and it's hard to envision stocks going up in the face of declining earnings. And so earnings are down 12% year over year. That's a big shift from last year where we saw a boom in earnings, and we're seeing the opposite this year with margins compressing. So companies are having a harder time passing on those costs to the end consumer, and you're seeing sales growth decline. So earnings down 12% year over year, down over 20% from their peak in the fourth quarter of 2021. And that's front and center, right? So you're getting all of these reports from companies cutting guidance in the future, talking about the challenging environment, and that's weighing on investors' minds. So, number two reason why people are thinking about are worrying that the bear market is not yet over is the economy, of course. And we've already had two consecutive quarters of negative GDP growth. Last 10 times we saw that the US economy was in a recession. I think the fear is that this will deepen, that the recession will get worse, and we'll start to see the impact on employment. We'll see more of an impact, let's say, on retail sales, and it'll feel like more like a recession for a lot of people, and that will drive stock prices lower. And number three reason why people are thinking about this may not be the end of the bear market is the Fed. And so, what is the Fed doing differently this year than in prior bear markets that we've seen? So, last eight bear markets, Fed cutting rates, Fed is expanding their balance sheet, buying bonds. This year, complete opposite situation. Fed is hiking rates in spite of a bear market. They're expected to continue to hike rates, as we've talked about, and they're reducing their balance sheet. So, for all of these three reasons, I think these are the three big ones. People are thinking that there's more to go, which is certainly possible. But I think people should understand also that the market's going to move before any of these things get better. So before earnings bottom, before the economy bottoms, history has shown us that the market tends to move up in advance of that. So just looking at early 2009 would be the perfect example. Market bottoms in March, recession didn't end until June. Earnings were still going down at that point, and very bad situation. But the market starts moving higher, and only later did the news start to change, and you start to see earnings go back up, economic growth resume. So certainly could be more to go, but understand that at a certain point, the market's going to start moving in the other direction, even though the news is still bad. So let's move on here, talk about the student loan forgiveness. And really, the big question is this the solution to the problem in my mind? And if we look at the chart here, I think the problem is obvious. The problem is that college tuitions and fees have just have outpaced the overall rate of inflation by just an enormous amount. So, in the last 30 years, you have college tuitions and fees quadrupling, just enormous increase versus a over 100% increase, so doubling in the CPI. So that gap is just enormous. It's not, it shouldn't be sustainable. It should be a problem that we're all thinking about fixing. I think the question is is the student loan forgiveness going to solve this? And so we'll talk about that in a little bit here. But I think this picture here is an important one because there is a problem, and there are many different ideas about how to solve it. So this is just I think one of those ideas. But first, let's break down what the forgiveness actually entailed. So we're talking about here about a few different things. One is just the big one that people are talking about is the debt cancellation. So if you have student loan debt, you're either going to have 10,000 or 20,000 in forgiveness, depending on whether you received a Pell Grant. And so there is an income limitation, but it's pretty high in terms of the limitation: 125,000 for individuals, 250,000 for families. So most people with debt will get some type of forgiveness. And I think they're going to be using the income levels from either 2020 to 2021. So either one of those years, I think that's what I've heard. So a lot of people are going to qualify for that. And you have also two other things in this forgiveness plan. You have this forbearance, which is the idea that people don't have to pay back their loans, and that's been going on since the start of COVID, and that was extended through the end of this year. And the last thing I think is a big one as well is this income driven repayment plan, which kind of changed the current rate of capping the percentage of monthly payments based on your income. So it used to be capped at 10% or more of your income, and now it's going to be capped on 5%. So if you're spending more than 5% of your income to pay back your student loans, you won't have to do that now. It's going to be capped at 5%, and they're talking about that the amount above that is not going to be added to your balance, but it's going to stay at zero. So presumably that's going to be covered as well. And so a final thing here they're talking about is you're going to have student loan forgiven after 10 years of payments instead of 20 years if you have a balance of 12,000 or less. So a lot of things in this bill. I think there's many different questions that people are asking. So I put together a list of questions that I've got from people in the weeks that and since this was announced. So a big one that people are arguing about is it fair? And I think there's many things you can argue to say, well, is it fair to the people who didn't go to college or paid off their loans a few years ago, worked to pay for college, or just entering college today, picked a lower cost school to incur less debt, or got a scholarship? So all of these people, of course, aren't going to benefit from this program, and they would argue, I think, that this is not fair. A lot of the people that are receiving the benefit are going to take the other side, saying, well, the costs are exorbitant. I didn't really know what I was getting into in terms of incurring this debt, and it's only fair that some of it is wiped away. So people can argue that. I think on its face, it's hard to say that this would be the best way of helping people with lower incomes, because it just doesn't encompass a wide enough group of those people. So as I'm sure everyone knows, people who go to college or go to graduate school tend to have higher incomes overall than people who don't. And here's a program, and a significant program, that's just helping the people that are going to school. And so if you wanted to help, if you're arguing that people are struggling and you want to help people with lower incomes who most need the help, I think a better way to accomplish that would be another type of stimulus program where you're just giving it to everyone and not just this one particular group. So, there's a lot of ways you can look at that, but I think it's a fair argument to say that there likely could have been a better way to achieve this. Is it legal? This is an important question. I'm not sure it's getting enough attention because of the problems that it might cause. This is a quote from Nancy Pelosi, who's the Speaker of the House, from in July 2021. She said people think that the president of the United States has the power for debt forgiveness. He does not. He can postpone, he can delay, but he does not have that power. That has to be an act of Congress. So traditionally, under the Constitution, the Congress has the power of the purse, so to speak. So a bill of this magnitude would not be allowed to be done through executive order. So how are they doing it? They're using kind of a loophole, which is based on language in the HEROES Act, which was passed after 9/11, to say that this is allowing them to do this broad forgiveness. And I think a lot of people are arguing that that's not the case. Ultimately, it's likely to go to the Supreme Court. And my guess would be if it did make it to the Supreme Court, it would be overturned. So does that mean that this debt forgiveness is not uh, going to happen? I don't think so. I think that it's going to be a race now between the administration rushing to push this thing through and a race to find someone to bring this case to the Supreme Court. And so to bring the case to the Supreme Court, you need to find someone who has what's known as standing. And that simply means someone who is harmed by this action and has a right to sue over it. And so it can't be simply someone like a taxpayer or someone who didn't receive this debt. It has to be someone who can show some type of harm based on this program. So people are talking about perhaps a loan servicer who would have made additional money had this forgiveness not gone on because they'd be servicing more loans. It would have to be someone in that regard. So I think it's going to be a race between the two, and if they procedurally, if they eliminate this debt in the next month or two, and the Supreme Court ultimately says it's not wasn't constitutional doing this executive order, it's going to be very difficult to walk that back. So how do you forgive $10,000 or $20,000 and then say no, sorry, you have to now pay that back? I'm not sure how any of that works. So for all of those reasons, I think it would have been much better if you agree that this should have been passed, that it should have been an act by the legislature to make it clear. If this was passed by Congress and the Senate and done in that matter, then there's no going back on it, right? And you have clarity, I think, for the borrower, more clarity for everyone. But I don't think they had the votes to do it that way, so they chose to do it through executive order. And so we'll see what happens. I don't think anyone really can say 100% that this is going to go through. But I think if they do push it through in the next month or two, it'll be very difficult to reverse. I'm not sure mechanically how you would do that. So third question people are asking, how much will it cost? There's various estimates of that, as we'll show here. A lot of the nonpartisan work that's been done is talking about somewhere between 600 billion and a trillion. And so it's hard to determine some of the projections, but at least 600 billion seems to be the low end in terms of what it will cost. How will we pay for it? That's a good question. Since it wasn't a legislative act and there wasn't something in there to say, let's say, raise taxes to pay for it, or raise corporate taxes, or institute some type of wealth tax. None of that was in here. So we will have to borrow the money to pay for it. So the national debt will go up by whatever amount that it ends up costing, until at some point in the future taxes may be increased to pay for that debt. So ultimately, who's going to pay for it? Well, we'll all pay for it in terms of the higher inflation that it will bring, but I think that's a hard thing for people to understand. More realistically, it's going to be the taxpayers at some point in the future will be asked to pay for it, and so they won't tie it directly to this bill. But what the estimates are, this is going to add, I think, around $2,500 per taxpayer in terms of the cost. So will it add to inflation? I don't think there's too much debate about this. There shouldn't be. I think both sides would recognize, and as we'll show, a nonpartisan study, really came out forcefully saying it's certainly going to add to inflation. The question really is how much, and we'll talk about that. And then Last 2 points here, and these are important questions because presumably, in part, this was done not just to help people, which I think it certainly will help the people that get this forgiveness, but uh, part of the rationale is that college costs are too high, so we need to solve that. And will this solve the problem of rising college costs? I think it's hard to argue that. Most of the studies that have been done uh, have suggested that it will actually increase college cost, and the reason for that may not be intuitive, but if you think it through, it actually makes some sense. If the borrower and the lender have less incentive to think about price, prices are going to go up. So one of the big reasons, and there's many reasons why college tuition has gone up above the rate of inflation, well above the rate of inflation. One of the big reasons is the subsidization, right, and the detachment of the cost of the college from that underlying borrower. So if the borrower is getting this huge loan balance, they're not viewing that as an immediate payment. And if they're getting that loan balance, regardless of the return on investment from that degree, the college is more likely to just raise their prices in response to that. So as the programs have increased the amount you can borrow in terms of colleges, colleges have increased their tuition and fees commensurately. So there's just less incentive if you subsidize a good, there's a less incentive to shop for a lower cost, and that makes, I think, a lot of sense. If let's go to the extreme example, if college was free, or you had all student loan debt would be forgivable, there would really be no incentive to pick a lower cost college over a higher cost college, and there would be no incentive for colleges to lower their cost. And thirdly, there wouldn't be an incentive for people to pick a degree that ultimately they believed they'd be able to pay off that debt in the future. So for all of these reasons, I don't think it's going to be a solution to underlying problem. Most of the studies that have been done are showing the opposite, where it's actually going to increase the cost of tuition in the future. So, and the last question I think is an important one: is this going to? This is wiping out a significant portion of the student loan debt. It's over 1.5 trillion in the U.S. But is this going to be a cure all and we won't have to do it again in the future? I think it's hard to argue that, because there's nothing in here talking about lowering the debt in terms of what you can take out or what universities are allowed to charge in the future. So unless there's something like that put in, this debt is going to build right back up. So as we've talked about, the someone who's just entering college now is going to incur this debt, and likely more debt, because the tuition and fees are going to go up. And so at some point, let's say 5, 10 years from now, we might be talking about another program to forgive this debt. So let's just very quickly run through some of the estimates that are out there. Again, these are all nonpartisan. It's not, one side or the other. These are nonpartisan estimates. Here's the Penn Wharton budget model. They're estimating around 600 billion as a kind of a base case in terms of what it'll cost. But they've in the footnotes here, they've talked about, depending on this uh, IDR program, depending on the details of that, it could go to over $1 trillion. So pretty substantial. By far, of course, the largest executive order that's ever been done. If it ends up going through, and a significant increase in terms of deficit and national debt. So that's what it will cost. The inflation question, a lot of different estimates here in terms of inflation. Very difficult, I think, to say ultimately what it's going to add to inflation, but it's going to add something. I think this is the Committee for a Responsible Federal Budget. Again, nonpartisan, has Democrats, Republicans on here, and they came out pretty forcefully saying that this program is going to add to inflation. This is not the time to do it because inflation is so high. And their estimate is essentially, depends on different assumptions, but I think this was their strongest estimate, that was going to be 15 to 27 basis points in higher inflation over the next year. So How do they estimate that? Why are they saying inflation is going to go up? Well, it's not the same as a stimulus program where if you gave people $10,000, they would go out and spend a good portion of that. That would really drive inflation higher. This is a little bit different. For giving that 10,000 or 20,000 is going to mean a lower monthly payment over the years to come, and that lower payment gives people more room to spend that money, and that increase in consumption, more money chasing the same amount of goods, is going to lead to higher prices. So that's the one big reason. The other thing they talk about, as we said, is this is likely to lead to an increase in college tuition and fees, so that's going to add to inflation as well. So those two factors they're saying is going to add 15 to 27 basis points. Ultimately, it's going to be very difficult to say exactly what it adds, but it's hard to argue that it won't add something. If you're giving people the ability to spend more money, that's likely to drive up the costs. Again, if it would be very different if this was a bill where it was paid for in terms of higher taxes, because those higher taxes would offset the people that were paying those taxes would have less money to spend, and the people getting the forgiveness would have more money to spend, and that would offset each other. Here, it's just similar to the stimulus programs, not paid for through higher taxes, and so it's likely to be inflationary. And just last point in terms of will we have to do it again at some point in the future? I think that's going to be a question. It will be an issue. Um, if the if this bill, if this proposal, this executive order wasn't put through, this would be the projected path of student loan debt. So it's a little over 1.5 trillion right now. This is with the forgiveness, it's going to drop down pretty significant amount. But as you can see here, this is the kind of the trajectory going forward. So pretty quickly, we're going to get back to that prior debt level, and presumably that's going to be a problem again. So this is not something that's going away. It's going to be something that we're talking about for years to come until we find a way to solve that underlying problem, which is college costs going up too much. And on that, there's a lot of different ways I think you can approach it. I definitely think that letting student loan debt be dischargeable in bankruptcy would be a good start. I would put more onus on the lender to say, instead of just giving an 18-year-old tens of thousands of dollars to borrow, which who in the right mind at 18 can make such a decision like that? Instead of doing like that, I would put the onus on the lender to say, is this degree going to be worthwhile? Do I believe this person can actually pay back that amount in the future? And if they don't, well, I'm not going to get paid back on that money. So more market-based system for loans, and just try to incentivize these colleges and universities to not raise costs the way they have. So as there's many reasons why costs have gone up. You have these unbelievable amenities in colleges. You have administrative costs going up like crazy. And as we're talking about the subsidization, all of these things are driving up costs. So we have to find a way to provide incentives for the students and the universities to be more efficient in terms of what they choose, and really finding a way to have people kind of maximize their potential through finding a degree that will pay off for them. So we don't want a system where people are choosing a degree regardless of what it will provide them in the future. So that doesn't seem to be a good system. We want to incentivize people to pursue careers that are going to pay them back enough so that they could pay off this debt and have enough money to live off in the future. So it's not doing people a good service to say, pick any degree you want, we'll forgive this balance, and don't worry about whether it's going to give you a job in the future or how much you make. So a more market-based system, I think, would be helpful. And so hopefully at some point in the future, we get to that point. So let's end here with something positive, as we like to do. and talk about things moving in the right direction. I think number one would be that rate of inflation, and I think it's likely to continue to come down here in the near term. And here's a leading indicator of that inflation rate that's moving sharply lower. It's the ISM Manufacturing Index. The prices paid component is really plummeting. And the last few times we've seen this, if you go back to the 1970s and 1980s, when the last time inflation was this high, you saw this ISM index come down first, and then the inflation rate followed thereafter. And so we're seeing that here again today. So hopefully this is once again a leading indicator of lower inflation, and we'll see this rate come down over the next year. And so what about gas prices and Labor Day weekend here? A lot of people are going to be driving, traveling. The good news is gas prices continue to move lower. They're now $3.80 a gallon nationally. That's 24% below their peak in mid-June. I think it was around a little over $5 a gallon nationally. So pretty substantial decline. If you've been filling up your tank, you probably noticed that. And so that's a good thing, putting more money in the pockets of consumers, more money to spend on other things. I think that's good news. Hopefully that will continue. And finally, this is something we've looked at, but it continues to move in the right direction. It's a index that tracks global container freight rates, so shipping cost. And what we're seeing here is a really dramatic decline now, down over 50% from the peak. And this will have an impact if it will continue. So still very high in terms of versus pre-pandemic levels, still very elevated. But if this continues moving in the right direction, I think that's going to be important in terms of the overall inflation picture as well. So good news on the inflation front, and we'll end with that. So everybody have a great rest of your weekend. Happy Labor Day, and we'll see you next week. Thanks for joining.